Hey all, welcome to Share Trek. This is Raj here. And friends, as always, with me, I have Sandeep out here, and he's going to help us understand what's happening with Invitae. So, Sandeep, thanks for joining us and giving us your weekends so that we can have this program every Monday.
Great to be here. Hey, friendos. Hey, Raj. Let's get going.
Thanks for coming, Sandeep. And our choice of Invitae today was triggered by Jesse Isaacson. Jesse had specifically requested that he wanted to see Sandeep do a little bit of analysis on Invitae. So here we are doing it. So with that said, let's get started. Welcome back, friends. I think it's time for me to hand over the baton to Sandeep so that he can walk you through Invitae. Sandeep, take it and run.
What a great time to be here. And it feels great to get a viewer request. If anybody else has any viewer requests like today's Invitae, feel free to put it down in the comments below or reach out and we'd be happy to do your request. It gives us focus and I really like it. It makes us much more interactive and much more engaging. And it is Halloween this week. So happy Halloween to anyone who celebrates. So my friend gave me this and I'm sharing this with you, the viewers. Friends also made these fun little cookies, and I am also sharing these with the viewers. And what a fitting theme talking about Halloween, because this stock we're going to talk about, it is in some ways, you could say, a horror show. This stock, NVTA, has been quite the bloody mess in many aspects. As you see, it's been a very, very steep roller coaster downward. If we were to even go into the week chart, at one point it was trading for $60 and now for less than $1, which is very, very jarring. And we got to ask, why is that so? So I went through the earnings. I went through the earnings call. I went through the earnings statements, the cash flow, the revenue statement, and the income statement, and the cash balance sheet. And what I discovered was very, very interesting. So first of all, when we're doing a fundamental analysis, what I like to do is start with cash flow. And what I discovered was a little bit interesting. This company right now has cash on hand of about $336 million. And that might sound like a lot, but if we take a look at their short-term liabilities, those are actually $226 million, which is great. It's able to meet its short-term liabilities. However, if we were to take a look at the long-term liabilities, those not so much. If I were to take a look and do an example, short-term liabilities, about 226 million. Long-term liabilities, almost $1 billion. This would be the case where if you were to have a credit card, you would focus on paying your interest payments, paying your monthly payments, but eventually you still got to deal with the principal. You got to deal with whatever you got to pay off. And Invitae, it's got enough money to pay this short term, but long term, it doesn't really look that great. So how does this company generate its revenue? And what I'd like to do is take a look at something really, in my opinion, cool over here. This is Seeking Alpha. It's a free website where you and I can look at any earnings. What I did here is I pulled up the earnings call and went through the entire thing so you don't have to. And okay, it's got the earnings statement, and you could take a look at whatever the earnings the CEO and the other management are doing. And what Alpha has over here is a little peer comparison chart. You could just search seeking alpha comparisons. And what I did was I put up Invitae with some of its competitors. Now we have a major, huge competitor like Thermo Fisher Scientifica. And although I did put it here, I didn't think it was a fair comparison because this is a massive titan of a company. And this is a small, in a way, mouse of a company. So I have some related companies which are much smaller and in that field and able to, in my opinion, be better comparisons. So this is a very interesting tool. So what does Invitae do? What this company does is it's in a way a diagnostic company and a not genomic sequencing company, but a genomic reading company where if you wanted to know what's in your DNA, what's going on with you, what is happening, you would go to Invitae and they would run some tests and they would see what's happening. A lot of its revenue, according to the earnings call, comes from oncology, which is cancer treatment. And this is a very, very large, very, very big segment and very serious segment. However, when I went through the earnings call, one thing I discovered is the types of treatment, the types of things that Invitae deals with is not really covered by insurance. It's not really things where if you were to have an insurance plan, if your company if your country has covered medical coverage, they would not cover for this. This is more of a pay extra sort of service. So Invitae, their service is quite expensive, so you wouldn't have coverage. You have to pay for this. And one thing that is very interesting and one thing that is very real is what's happening with the economic cycle. I know, Raj knows, many other people out there know that we live in a very uncertain economic time. And during these time periods, people cut back on spending, and rightfully so. Invitae is somewhat of a cyclical business in a way. And as people cut back, as people spend less on some of these more expensive things, Invitae is one of the companies that looks like is suffering. As I went through their revenue and their earnings statements, I noticed that their revenue is down 12% year over year. However, if you were to take a look at some of their revenue from the prior year, from 2021, from 2020 and 2022, when Invitae was at its peak, its revenue was about over $1 billion. And right now, its revenue is 120 million, which is just a significant drop, which kind of coincides with how people have been cutting back on spending. And one thing I also notice over here is their margins. This company has about 50% margins, which is insane. One of you might remember we were talking about NVIDIA, NVDA, which had a margin which was amazing of 35%. This is a margin of much greater, but a much smaller cohort of clients. So why is this company being beaten down so much? Aside from the business cycle, aside from being a cyclical business, and that is what I believe two big words: cash burn. Cash burn is a concept where is the company losing more money and going through more cash than it has available? And I did a little bit of math, which I believe will be very interesting for all of you. Right now, it is going through about right now, it has about 355 million in cash. Before it had the prior quarter had $557 million in cash. This company is losing about $1.23 million every single day in cash just to stay afloat. That's not as bad as last year, though. Last year, it had $2.5 billion in cash and went down to $206 million at the start of this year, which is a loss of about $6.8 billion, sorry, $6.8 million every single day. So if you think that you're not doing so well, I'm sure you're doing better than $6.8 million of losses every single day. As I was going through their earnings call, it said that a bunch of the sectors that I saw a lot of growth in was women's health. Oncology is growing steady, but very, very big changes, big growth in women's health, which is quite interesting. But this company, I believe the issue that it had was it just customers are not willing to pay, and it doesn't have the cash to sustain. And what I really liked about this company is it is cutting down on expenses across the board. All of his expenses got slashed over 50%, which is great. It is knowing how to cut back, but it might be too little too late. Its cash burn is down from the prior quarter of 275 million to now 220 million, which is great, but maybe not enough. Last year, when it was losing $6.8 million a year, they did not do the very, very strict actions that it needed to do then. Because of that, it's suffering. Quarter revenue down 11%. However, their net loss is down by 85%. They cut their net loss, which is a great thing. And how did they do this? One interesting thing is I went over here to Invitae's list of financials, and I took a look at all of their recent things. What this company did, and what I believe has really hurt the stock, is this company has financed this debt through issuing shares. You and I, the shareholder, right now, the company has about 60% ownership through institutions. The rest of the other 40% are just average Jew folks like you and I. We help pay for this debt. The company has issued a bevy of shares to fund all of this. And just in recent times, I went through, they're doing a $3.5 million share offering, in addition to an 850,000 shares offering, in addition to a $26.6 million share dilution, in addition to a $389 million common stock dilution through convertible notes. And funny thing about those convertible notes is this company gave those notes to this firm called SB Northstar, Chimera Investment Capital, and Baker Advisors way back in 2021. And back then, the company stock was trading for quite a bit. Those are being converted now, and they are being sold now when the company has been just slashed in half. So these institutions have lost big time. However, the company needs to do this dilution because it's not making enough cash. And right now, the company has enough cash to survive, but it doesn't have the cash to meet its long-term obligations. Because of that, I worry for the company. I worry that it needs to keep going to the shareholders and dump on us, the normal folks, the average you and I, because it's not making enough money because it's rather cyclical. It is showing a lot of promise. It's cutting its expenses, it's raising its revenue, and it is cutting its cash burn. But is this doing it fast enough? That is something that I think if it would have taken these actions maybe last year, would have been a much more favorable story, especially with a company with 50% gross margin. But maybe it didn't act fast enough, which is very, very interesting. And I'd like to also share another little tool of mine in addition to that Seeking Alpha, which is stock analysis. We could take a look at many of these ratios, which I like to tout in some of these other videos, it's very well organized for you. So feel free to use this. Free cash flow yield. It's losing a lot more money, but I'd like to draw attention to this: enterprise value and market cap. Market cap is a total value of all of its shares, equity. Enterprise value, the total value of all its debt, bonds. If you see that massive discrepancy, it's that it has a lot of long-term debt. And right now, the market cap, they could keep dumping on us. They could keep diluting shares, but it's a very, very, very high ladder to reach that 1.5 billion, which it must pay back. And that also kind of explains why this company is 20% short, which is very, very large and has a consensus sell forecast estimate. Another cool little thing is Yahoo Finance. We got in the statistics tab a lot of great ratios, including enterprise value, market cap, and also the institutional ownership right here in holders, which I think it would be pretty cool. So check those out in your own time. Invitae, in conclusion, very great company, very high margin company, a company which is doing a lot of good for the people who could afford it. But during a cycle where we have people cutting back on spending, especially the folks in the higher income bracket, where if you have like say $1,000 of credit card debt and your interest rate goes from 16% to 20%, hey, that's an extra what, like $100 you got to pay? Whereas someone who has billions of dollars of debt, that increase in interest rate means millions upon millions of dollars, which is clear over here. So the richer cohort are suffering, and that is the clientele for this. LVMH, one of the largest companies in the world, is showing a big, big slowdown. This is a cyclical business, and it doesn't seem like the company took the correct steps fast enough in diluting shares to answer their debt problems. It's doing a good job right now. It is cutting down on spending and it is growing. But that $1.5 billion really alarms me. So it's very risky for me right now. But if it were to survive this very longer for higher for longer interest rate environment, if it were to survive, the company looks very appealing to me, especially with that margin. If it were to solve that cash issue, I'd like it. But right now, it's very risky. And because of that, I'm watching it. I'm seeing what it does. But I don't think I would be investing right now, especially with many of the other deals on the market. But Raj, what'd you think of what we put together? I'd like to bring him back.
Sandeep,
And
it
get
was
some
very
thoughts.
interesting. I was listening very carefully to what you were saying. It's interesting, and I think that you are saying people are not buying enough, and it's cyclical. So I was a bit concerned about that, mainly because we have this concept of elastic and inelastic demand. It's one of the economic concepts where essentials do not react very badly to increase in price or even in difficult times. So the very extreme example is salt. Just because inflation happens, the price of salt goes up, say 100%, still people will buy salt. They can't live without that. The other example is luxury goods, right? The more expensive, the better. So people buy. So these are inelastic. And the elastic ones are the ones that are, things you can do without. Like, for example, we used to have something called as a yo-yo that used to play.
Yes.
It's not essential.
I remember yo-yos. I'm not that.
For example, extreme example, it's not essential. So if you raise the price of the yo-yo from maybe 50 cents to $10, whatever fancy colors you put, nobody's going to pick it up. Right? So that is a very elastic demand. So I was always of the opinion that healthcare and diagnosis is relatively inelastic.
Yes.
But it's very interesting to see that their revenue has dropped.
Yeah.
Now, I don't think the revenue has dropped because of people's purchasing capacity, but I think it's probably dropped because of the way we work these days, people working from remote. And during the COVID period, many people were locked out. And the hospitals decided to postpone elected surgeries and all those things. If that is the way, that is the reason why these things went down, then I'm very optimistic that they will start going up again as we start emerging out of COVID, and the hospitals are back into capacity when then the specialists can prescribe various gene tests, and then they can go and get it done in Invitae. So that's one thought I have. The other thought I have is that this is in direct competition with Grail. So as Grail gets divested and it gets 2.5 years of running money from Illumina, it's out there trying to stand on its own. It's going to be aggressive, and if it comes up with a really good product and it manages to take leadership, then that's going to directly hit Invitae. But on the positive side, I just recollect my video from yesterday where Pacific Bio has had a collaboration where they are integrating two technologies for short reads. Those kind of things are going to make machines cheaper, and genomic sequencing will become even cheaper, and therefore capital costs will get less, and Invitae can have a much wider presence to collect all these genomic tests. So in a way, I am tempted that it looks positive, but when I look at the $1.3 billion debt that you mentioned, that scares me, because with the high interest rate regime, if I'm looking at two ways, I don't know if I'm thinking right, but if the 1 billion plus has been in terms of convertible something, right? Some kind of convertible instrument. Yeah, you can see that there, right?
Yes, 400 million of those are convertible notes.
400 are convertible notes. So if they get converted, so I don't know if they were a fixed rate at which they are going to be converted, in which case Invitae is going to get a boost because suddenly Invitae is going to get a discount on its payment. Because if Invitae had entered in to that convertible note saying that you're going to get this many shares worth this many dollars each, then right now they will give that many shares, but it will be worth less in the market. However, if it said that they are going to give all of that in Invitae shares, then at 50 cents a pop, it's going to be huge equity dilution.
Yes.
So that is one of the aspects that worries me, because I don't know what that convertible note is structured like. We will find it out another day.
Actually,
we can't do it on the...
I do have some of those answers. So the convertible notes, some of them have an expiry. It doesn't say that you can only convert during a certain time. I didn't get that information, but I do have some of them expire in 2024. Some of them, the latest ones expire in 2028, which, interesting enough, these kind of correspond with the U.S. election. So maybe that's just coincidence.
Yeah. So what do they become when they...
Yes. So these... Pardon me. Yes.
Sorry, go ahead.
They convert to common shares, common stock.
And does it say in what ratio, what rate, or does it say that shares worth?
I did pick that up. That was, I said 1.5%. So if I were to do a little bit of math, I believe that is 150. So one note would equal 1.5 shares.
Okay.
Understand correctly? Pardon me. I will get to
let us check that and come back again. But the way I'm looking at it is that if the terms of conversion were X number of shares, right, at the time of the termination, if it's going to be converted to X number of shares, Invitae is going to be in a happy position.
Yes.
But if at that time of conversion, it becomes dollar value, then that's going to be a truckload of shares at this rate.
Yes.
At 50 cents, right?
From what I read, they were converted to shares at the market rate.
Oh,
I
then
will, but I will make sure of that. And another thing which pardon me, I forgot here is one thing I noticed is that the management is also getting a lot of
options.
shares, yes, options, warrants, and investment plans where they're getting shares. Like the CEO got just recently gave himself $3.5 million bonus, which is something, with an additional $1 million in cash and 100,000 additional shares warrants. Same thing with their COO and their CFO, but at smaller quantities. They're getting cash, but they're also getting a wee bit of shares.
Right.
Pardon
So
me.
overall, equity dilution is a concern, and the
Yes.
warranty redemption is a concern,
Mm.
because that's going to be that 1 billion number out there, 1+ billion, seems very scary. And the question of whether they will survive these difficult times is another big question, because competition is coming hard and fast. And the fact that they are not being covered by insurance is another big
Yes.
issue, in my opinion. So overall, from that point of view, it looks bad, but the margins are pretty good. But for that margin to make any sense, they have to have huge turnover. And if they manage to get huge turnover by some means or the other in the next quarter and the quarter after that, and go
Yes.
back to their original levels, then things would be better. But if the original boost was because it was a novelty and people thought that it would give great insight, and then they found that it was not worth it, and that's why they dropped it, then that's not a good situation to be in, which means that the growth is not going to be fast. It's just going to grow slowly.
Yes.
So those are my thoughts, Sandeep. I have not analyzed it too much, but I would just go and have a look at their price chart just for
Yes. Yes,
Jesse.
please.
I'm going to give me 1 second. Let me pull up the chart, and I will switch it on here, Invitae, and let me share the screen so that you can see it. And you look at this chart. It's
Yes.
the chart for Invitae, and each of these candles are a one-day candle. So if you look at this candle, for example, 1.43 is at the top, and at the bottom is 1.32. That is 10 cents on a base of 1.4. So that is a huge drop. So
Yes.
the longer the candle, the bigger the drop. So the drops are all substantial, and there are very few upwards green arrows or green bars. That indicates that there are very few days when the share has opened low and gone up. The last 2 days have been positive, but you can see this thick red line out here. Now, the thick red line is basically the 9-day exponential moving average that we see here.
Yes.
And it is acting as a resistance for the share price at this point of time. Momentum is below average. MACD is bullish, but momentum is very low to make much of a difference. And if I look at the news items here, it says Goldman Sachs adjusts price target on Invitae to $0.50 from $1, maintains sell rating. So they have discounted it by almost 50%, and they are saying sell it. So that doesn't look very good. And now if we were to look at what's happening next, on November 8th, they are going to have an earnings call, and it's expected that they would come up with an EPS of negative 0.31 cents and revenue estimate of 120.766. So I think they may probably meet their revenue estimate, but if they don't meet their EPS, that's going to be bad for the stock. Now, if you were to look at the previous earnings, they bet on both revenue as well as EPS. Still, the EPS was negative. And the one before that, they bet on both revenue and EPS, and still EPS was negative. So it has not been a profit-making company, but their revenue, they have been able to meet the revenue, even if by 1%. So revenue, I think they should be able to equal or, be very close to the revenue target. They don't have too much of a beat, which means the market has a good read on the revenue. So I think they would come somewhere around 120 million or 121 million, something like that. But what I'm worried about is they may end up with more negative, because interest rates are high, inflation is on the market. So
Good
with all
point.
those things in mind, I'm thinking that the earnings may not be good news, but if we are surprised by the earnings and it comes out well, it beats both on EPS and meets the revenue or slightly exceeds the revenue, then the share can see a little bit of a pop, but I think that will be short-lived because anyone who sees that $1 billion number out there is going to panic and not
Yes.
stay there for too long. Somebody might do a swing trade here and there. The risk-taking people, they may buy or they may sell some calls and then take the money at the other end. So that's what I think might happen out here. So that was what I wanted to add, Sandeep. Anything else you want to say?
You bring up a very, very interesting point in regards to trading, which
Yeah.
something that crossed my mind is right now that it's trading at it pretty much 52-week low. At some
Yes.
point, it becomes value, and it has about a 20%, give or take, short interest. A lot of the time, when there's a change of sentiment, when all of a sudden the market goes bullish, these heavily shorted stocks do see a little bit of a trading bump
That
because
yeah.
shorts start to cover. So that's something interesting.
That is interesting. At the same time, I think funds will not buy this share. That's a big
Yes.
negative. It's a
Yes.
0.5. And you know, if you recollect, there were many companies like SQZ Biotech, which was delisted. And there were other companies like that. I forget the name of
Right.
another company which came very close to this situation. I will remember it later on, not right now, after we finish the recording. So
Yes.
Invitae is quoting at a very low price at this point of time. So we'll have to see if they get any notice about meeting the listing requirements.
They did actually. One
They
thing
did?
that I found was
Yeah,
they didn't get a delisting notice. They got
yeah,
what was a warning saying you have traded under $1 for greater than 30 days.
yeah.
And this is just a warning. You're not getting delisted, but you're being warned.
Yeah,
So
so
it's something to consider.
that will prompt them to do a reverse split. And when they do reverse split, it provides opportunity for further fall in the share price.
Yes.
SQZ Biotech did a reverse split before it got delisted, if I'm not mistaken. Because when you do a reverse split on 0.57 cents by doing a 10:1 kind of a thing, 10 shares is equal to 1 share, then suddenly you have a decent price for the share. But unless you look inside the balance sheet and see that $1 billion hanging on the head and the income being so low, you will not realize that. So that $5.74 might attract novice investors who do not know anything and who just thought that it is cheap, will buy and will take a risk. Those kind of people might lose money because it's going to start going down, because the other smart ones who have been holding for a long time will say, okay, this is a good time to get rid of the shares while it is still possible. And it could go down unless, as you said, they improve their cost cutting continues very well, and they start franchising their business, for example, so that they can have franchise collecting centers, and then they start collecting a fee for giving the franchise, and they start collecting percentage revenue and all that, and expanding their reach to the places that they are not able to go right now. Those kind of business models, I think, might help if they're not already doing that. I don't know if they're doing it at this point of time. But there are ways in which the company can try to improve its reach, especially because it's gene testing. They could even have, I guess they have postal collection also, right? Like you can give the sample from home and send it by post, and then you get a result online. Those kind of things are also possible. Advertising for their product and all those things. But again, that's an expense where there is no guarantee that there's going to be a return. So anyway, I think I won't touch this stock, at least for the near term. I'm going to watch what happens. Let us see the earnings.
Yeah, definitely something to watch
to
see if they can improve their financial position, and if the economic conditions improve. Something to watch, definitely, for me at least.
Yeah. I hope Jesse enjoyed this session and got something worthwhile. And Jesse, if you have anything that we have not covered that you're thinking about, please put it in the comments. We'll love to hear from you. And anyone else who has been holding Invitae, I hope you found some value in this video. And I thank Sandeep once again for helping us with another video, and we'll catch up with you again on Monday. And if any of you have any stock that you want Sandeep to look at, please put it in the comment, and we'll make sure that we cover that, assuming that we get enough data from sources. Otherwise, it's going to be difficult for us. With that said,
please.
I would like to say bye, and thanks, Sandeep. Take care.
Bye, everybody. Happy Halloween if you celebrate.